Hey guys, welcome to Market Mondays. Hopefully you guys had a great weekend. I'm here to give you guys an update on everything that happened last week. But before I get right into it, I'm gonna do a quick dad joke. Dad joke today is, what do you call a sleepwalking nun? A sleepwalking nun. She's a Roman Catholic. Roman. Get it? Pew pew. All right. So getting right into it, last week was a really big news week with a lot of stuff going on. We got a bunch of inflation report. We got an inflation report. We got a Fed meeting. We got a bunch of jobs reports. So I'm going to go right into it and tell you guys how it's all impacted the market. So first thing we want to talk about is the Fed did meet and they decided not to raise rates or change rates at all, or even lower rates. They're going to keep holding that off, which was actually funny because they did it a few days just before the unemployment rate came out. So there's a chance that moving forward, maybe in the next meeting, maybe later in August, maybe in September, they may consider bringing down the Fed funds rate. However, the other thing that came out the following that day is something called the last inflation report for the month, which is PCE. Now, the thing about PCE is that that's the one inflation report that the Fed is keeping an eye on. Not really the other two, but the one they're keeping an eye on is PCE because they're trying to determine if they should use that as an indicator to lower the Fed funds rate as well as unemployment rate. Unfortunately, that did go up. However, that was expected. So for the most part, the PCE inflation report actually went up by like 0.3. But the main thing that really drove mortgage rates last week was the job market. So overall, we saw the softening of the labor market, and it was really exciting to see just because mortgage rates really responded favorably. So to give you guys an idea, the unemployment rate did go up to from 4.1 to 4.2%. Now, that's really big news because we know based on all the other reports that we've seen that, the continuing claims for unemployment, people who continued for file for unemployment, it stayed up. It stayed and has it been at 1.9 million since mid-May. So, and we've been above 1.8 million for the last year. So that's 1.9 million people who are still filing for unemployment benefits. So we've been wondering over the last 2 or 3 reports on unemployment rate on why hasn't this gone up more or sooner? It just didn't make sense. Well, in addition to the unemployment rate coming out, is that there was a lot of revisions done over May and June. So in May, they were saying that there was a job growth of 144,000. In this revision last week, it was actually only 19,000 jobs grew. And in June, it was stated that in June it was 147,000 jobs. It was actually only 14,000. So there was basically 258,000 jobs that were just made up based on this crazy modeling, and then they revised it. Now, shortly after the report came out, the head of the BLS, I guess, department was actually fired. So they're finding a new person because there just been crazy numbers that are being reported and they're not even real. If you guys remember last year, BLS admitted to saying that they basically made up 800,000 jobs on a report on a revision, and then really they finally revised it and realized the job numbers was actually a lot worse than what they actually reported. So between the unemployment rate going up and the revisions for May and June showing that the job market was actually a lot weaker than expected or what they reported, it really improved rates quite a bit. So we'll get into that just a little bit, but PCE again went up as expected. GDP, gross domestic product, did improve by 0.3%. But another thing to add on to that, I'll just give you guys an idea what PCE is doing. But another thing to add on to that is the overall appreciation of homes since last year is still 2.3%. So what that means is that there's still homes appreciating, and it's not as fast as it was back from basically 2019 to 2022, which is good because we did see almost double digits appreciation on average across those 3-4 years. So the fact that appreciation is going the opposite direction, I think it's a good thing. Makes it a little bit more reasonable for home prices to go up a little bit, but not too crazy. So obviously, if you bought a house within the last 2 or 3 years, it's going to be very difficult to have equity. But on the bigger grand scheme of things, it is going to help make homes a little more affordable, and hopefully our wages catches up to all that stuff. So, but to give you guys an idea of what mortgage rates have looked like since Friday, We had this big drop on Friday. It went down to even just the low sixes finally. And then today it's actually another solid improvement. We don't know what's going to happen next. There's some reports this week that we may get some more additional labor market news that will show further indications that the market is softening. But there's also replacements in the Fed board and as well as the BLS head, the CEO of the BLS. So we'll see how that goes, and hopefully they're making better and more accurate reports as to what's going on with the job market. But yeah, for me personally, I actually locked a lot of clients last Friday because that's what I was expecting. At least I wouldn't say expecting, but hoping. So with a lot of clients, we actually ended up saving them almost a quarter% into a few $1,000s on their rate. So luckily, I was able to time that really well, and then we were able to lock a lot of clients. Even locking right now is actually a good idea too. So I would, if clients are going to be closing in the next 20 to 30 days, this wouldn't be a bad time to lock for clients who are under contract right now. Otherwise, hopefully that was helpful. Hopefully you guys got some information out of that. Otherwise, nuke out.